Hey everybody, this is John, and welcome to the free video for Simpler Options. So let's take a look at Facebook. Facebook was kind of the big earnings trade today. In terms of after hours, you can see it closed at $76.24. After hours, it's $74.65. So the question is, especially with earnings plays, how do you play these in a way that promotes consistency? So for Facebook, and this is part of what I'm going to talk about on our class this Saturday, is trading earnings for consistency, because earnings kind of have a reputation for blowing up in people's faces. Like everything's kind of good, and then all of a sudden there's that one that got away. And you never want to put yourself in a situation where you're risking consistency of an equity curve, meaning that it's slightly uptrending, right, all the time. So what do we do with Facebook? So for Apple, well, let's look at, for Apple, I did a put credit spread. Okay, we talked about that one. That was great. Apple, gapped up today and got max profit on it. For Facebook, instead, it was an iron fly, which essentially is selling a naked straddle. Okay, so I sold the 76.5 call and the 76.5 put. Got a lot of premium on those, but not risking the wrath of a 2 standard deviation move. So buying the wings, which essentially is just outside of the expected move. Now, at this point, we are at 74.50. Who knows where it's going to end up tomorrow morning, but that's good. That's exactly what we want to see. So what we're looking at then, of course, max profit on this trade would be as if we pinned at 76.5 at the end of the week, we'd make let's see, 70, right there, we'd make $4,000, right? I mean, that's the premium that we'd collect. So I'm not looking for that. I'm just kind of looking at, what if we can stay within the range here? So right now with the implied volatility, you can see there's not going to be much movement, but tomorrow we're going to see the implied volatility collapse, so that if we are around 74, then that's some nice coin there. But the main thing to keep in mind is what would happen if this trade blew up. What would be the maximum amount of risk? Well, $2,200 to the downside, $1,200 to the upside. Okay, and it was kind of an unbalanced condor or iron fly in that way, and taking into account the idea that if it's going to do anything, it would probably explode to the upside. Okay, so it took a little bit less risk on the upside. And so anyway, hopefully that makes sense. So that was constructed specifically with the idea of how do we take advantage of an earnings trade without this thing blowing up in our face, okay? And then along those same lines is how do we take advantage of this crazy market? Because, Apple's exploding higher, but there are a lot of things falling apart. So LinkedIn, this was a nice trade that we had done on LinkedIn yesterday, where I looked at it as even if the markets are strong, this stock really isn't acting too hot, okay? And so we did the put debit spread and a call credit spread. In fact, let me arrange these so we can actually see it by trade. Okay, so now you can see the 225, 220 put debit spread, which is essentially looking for a move below 220 for max profit, right? But of course, the 225, 230 call spread would benefit if we stayed at 225. So the way this position was deliberately constructed that, ideally we close below 220. That's going to give us max profit. But if we close the week at 225, it's not a big deal. So let's take a look at this equity curve. So what's nice about this P&L curve is that it's the maximum risk. So the maximum risk on here is $2,865, and that's if we close above $230 at the end of the week. If we're at $225 at the end of the week, then you can see, let me get close to there. You can see we'd be down about $300, right, at 225, $300, $400, which if we had just done the put debit spread, okay, it would have actually resulted in a bigger loss. Like, let me take out the call spread here. So call. So, had we just done the put debit spread and closed at 225, then our loss would be like $1,000, right? Instead, we added the call credit spread, and if we're at 225, then a loss is closer to like $300. So the idea here is just making a bet that it's not going to really go above $225. And if it does, of course, if it, whatever, surprise upgrades and stuff like that, the risk isn't that high. So that trade was constructed in such a way as to promote consistency, as was Tesla. Okay, so Tesla, now for Tesla, one of the things that I wanted to look at here was taking advantage of the downtrend here. And we've got a new position here that's being bid on, but we sold a call spread. So we did two things here, and we'll look at the chart. But in this case, we actually set it up in a specific way as well to maximize it. Now, first of all, we went 9 days out and did the 215, 220 call spread, which was further out of the money, okay, and then the 205, 210 call spread, which was in the money. And the idea with this, of course, if this thing explodes higher, then we've got some adjustments to do. But here we get fat premium here, and then we get high probability premium here to take advantage of this. So if we go back here and we looked at LinkedIn, we can see that the idea and the theory behind this was that, hey, on a daily chart, we are kind of stuck within a downtrend here within a weekly uptrend, okay, daily downtrend within a weekly uptrend, which is kind of what the market's doing, okay? So when I saw that we actually pushed below here and we started rallying back up to the fire line, that's when I initiated the call credit spreads with the idea that 225 was going to be a tough barrier for the stock through this week. And of course, those are the options for LinkedIn. The options that we're focused on are expiring this week, okay? Now for Tesla, we went out an additional week because Tesla has got a little bit more volatility there. But to me, this is a straight up, and part of the reason I love this is that everybody's buying calls on this stock. That's a downtrend, right? So when it rallied today up to resistance, it's like, all right, we got to sell some call spreads on this, and I'm looking for lower prices. I think 143.92 is in play, and would actually like to get more exposure to Tesla buying puts. All right, so this is the kind of stuff that I'm going to be talking about on Saturday. New Year's resolution was create the most consistent equity curve possible while allowing for the possibility of home runs, okay? And this means really focusing on minimizing the downside, and that's a huge mental game as well as having the best trading knowledge on the planet, okay? And it comes down to being able to not only look at a setup, but understand that, hey, you know what? On this one, we're going to do both a call credit spread and a debit spread. And on this one, we're going to do an iron fly. And on this one, we're going to do just a put spread. On this one, we are going to buy a Delta 20 option, okay? And it's understanding how to mix all of that in with the idea that the main priority is consistency, okay? So this is a class I'm going to dive into on Saturday. This is going to be a game changer. We're going to be talking about how to create a consistent equity curve so you can get off the roller coaster and sleep at night. Well, you guys can read this stuff. But the idea with this is that at the end of the day, what I've found, and if you're seeing this, you can sign up for the $297 price. This will go up for $997 once it's up on the site. But the idea with this is, at least from what I've heard from people, is that at the end of the day, we all have the fantasy of, buying an option at 25 cents and selling it at $10 and doing that over and over and over again. And yeah, it's possible that that happens once in a while. But what I've seen with most accounts is that while they're doing that, they're like, wow, I got this big winner. Then they lose all those profits trying to get the next one and actually go negative, okay, which isn't good. And a lot of people are kind of like, you know what? I actually just want to make a consistent income. I'm fine making 20% a year. And to me, that's boring because I know the possibility is so much higher. So my goal is 2.3% per week, okay, which is like 120% a year. And that's the target, with the possibility that it could actually be much higher than that, but taking risk into account that means that you don't blow up, okay? You don't sit there night after night going, what am I doing wrong? Why is this not working? So that's the goal. So anyway, I think Saturday is going to be a game changer for a lot of people, and I'm really looking forward to it and looking forward to have you there, all right? There's the link, simpleoptions.com/class, and looking forward to working with you and kind of taking the next step on the journey with you guys on Saturday.